Hello investors. Welcome to IM Infographics YouTube channel, where we dive into the smart strategies that big players use to grow their wealth. Today, we are uncovering something every serious investor should know: intrinsic value. Secret to picking stocks like a pro. Let's find out how to calculate this hidden number and make smarter investments. Imagine you are eyeing a property in your city. Just because it's listed at 1 crore doesn't mean that's its real value, right? You would look at factors like location, potential rental income, and future value. Well, in the stock market, intrinsic value is like finding the real worth of a stock, regardless of its price tag. Alright, let's dig into how we calculate intrinsic value, specifically using a method called the discounted cash flow, or DCF for short. Don't worry, I'll break it down into simple steps, and we'll even run through an example. Step 1. Estimate future cash flows. Think of cash flows as the profits the company earns each year. Now, imagine IMI Motors earns around 1000 crores rupees annually, and let's assume its earnings grow at 10% every year. Why 10%? Because we are optimistic. IMI Motors will continue to expand its market. Then only the story goes on. We estimate IMI Motors cash flows over the next 5 years. Let us assume they currently make around 1000 crores annually, and we expect this to grow at 10% each year. So, next year's earnings would be 1100 crores, because we are taking that original 1000 and adding 10%. The following year's earnings would be 1210 crores, which is 1100 crores times another 10%. And we'll continue this growth for all 5 years. For third year, that's 1331 crores. Fourth year, 1464 crores, and by fifth year, IMI Motors' expected cash flow reaches about 1610 crores. So in total, we have our future cash flows for each year. Now step 2. Discount the future cash flows. In finance, future money is worth less than today's money. To adjust for this, we discount future earnings by a rate, like 12%, which reflects inflation and the risks of investing. Let's call this as discount rate. Discounting the cash flows. Let us adjust each year's future cash to what it's worth today, using a 12% discount rate. Think of this rate as a combination of inflation and the risks of investing. Here is how we calculate the value for each year. For first year 1100 crores, divide by 1 plus 0.12. That gives us 982 crores in today's terms. For second year 1210 crores, we do the same, divide by 1 plus 0.12 squared, giving us 965 crores. And for the next few years. Third year becomes 940 crores, fourth year is 913 crores, and fifth year is about 912 crores when we apply that discount. Remember, each number here reflects that year's earnings in today's value. Step 3. Sum up the discounted cash flows. After discounting each year's earnings, add them all up to get the intrinsic value for the next 5 years. Our total for IMI Motors here is about 4712 crores. Now, let's compare this intrinsic value to the current market price. If IMI Motors stock price suggests a total valuation of 3500 crores rupees, it's undervalued compared to its intrinsic value of 4712 crores rupees, a promising buy. But if the stock valuation was above 4712 crores rupees, it would mean the stock is likely overvalued. So why does this matter? By calculating intrinsic value, you are not just speculating, you are making informed decisions based on the company's true potential. This is how some of India's top investors identified undervalued stocks and built massive wealth over time. Feeling ready to use intrinsic value in your investment strategy? Join the journey to smarter investing, where we simplify finance, share tips, and reveal insights for building wealth, because financial wisdom is your best investment. Thanks for watching. Remember, whether you are a beginner or a pro, knowing a stock's intrinsic value helps you buy with confidence and avoid costly mistakes. See you next time on IM Infographics. Happy investing!